Good evening, everyone. Welcome back to our CFA Russia's webcast. It is our monthly routine and the tradition to make a macro summary with a prominent economist. This time, again, we welcome Andreas Bickel, CIO at Blackfort Capital, a Zurich-based investment company. And Andreas Bickel has over 25 years of experience in portfolio management. He was head of portfolio management in Russian Bank Switzerland and Goldman Sachs Switzerland. The Russian side, the Russian perspective of the macro environment will be provided by Maxim Matveyev, CFA, CEO at Atera Capital, Russia-based investment company. Welcome, Andreas and Maxim, and the floor is yours.
Yeah, Vladimir, thank you for the introduction. Historically, September is the single worst performing month for US equity markets. As they say, September is when leaves and stocks tend to fall on Wall Street. It's the worst month of all. And indeed, the beginning of school season this year was no exception, with S&P 500 declining 5% and NASDAQ almost 6% over the last months. So what kind of lessons have the markets learned last month? Let's discuss it at this webinar and on global financial markets. And I'm passing the word to Andreas. Please go ahead.
So good evening from my side. Thank you both for the introduction remarks. Let me share, as usual, my screen with you. So as already mentioned in the introduction, September is the worst month of the year. And this year, September behaved the way it should, based on statistics, based on history, different to the rest of the year. So the key question obviously now is, shall you buy this dip again, or shall you use rallies like yesterday in the US to sell? To get an answer to that, we go as usual through the macro side, where I have found an interesting twist in the US market. We will obviously cover the drop in Chinese bond markets and in general bond markets. Then having said that September is one of the worst months of the year, obviously the next question is, what shall you expect from October? And given that some indicators and some real economic data is weaker, what will that mean for equities? And last but not least, I will cover briefly some of the commodities and precious metals. One disclaimer, I hope my voice is holding on. I was sick over the last 3 days, so I try my best that I keep up with being able to talk. With that, no further ado, we go into the first topic, hopefully. Here we go. This is the usual slide, but this time I have tweaked it to Asia with the exception of the yellow line. Key messages you can take from here is the Chinese official Caixin PMI data has risen slightly, is at the growth edge area at 50. Even more pronounced was the rising in the non-manufacturing area. So the service sector does pretty well in China. In particular, if you compare to the news flow we get over the last 4 to 8 weeks. Then Taiwan and South Korea, both are kind of leading countries when it comes to global growth. You see that South Korea is recovering from a slowdown and is slightly in the growth area, but not in the acceleration area. And Taiwan is the opposite story. Taiwan was having a strong move and is now decelerating and has fallen below 55. As a proxy for world export, the German manufacturing PMI is shown here too. You see there is a fall, but with a level of around 58, that's definitely deep in the acceleration area. So from the angle of Asia, the growth expectation of all these companies who participate in this survey is surprisingly strong. If we turn to Europe, we see that the data is above 55, so still in the acceleration area. However, it keeps falling. And you see in the table on the right-hand side that most data are on a 4 to 7 month low, but all of them so far at least have managed to keep up in the growth area. If we dig into German economy, which is the fourth largest economy of the world, you can see that the ZEW and the IFO lead indicator, they paint a darker picture for the next 3 to 6 months, while the PMI data is rather giving you insights about what's going to happen in 9 to 18 months forward looking. So also Europe, it is surprisingly resilient, but it's slowing down. And now, for me, that was the big surprise. ISM manufacturing, so the traditional, old-fashioned, since more than 80 years existing PMI data from the US has reclaimed the level of 60. So we are now in the acceleration area and on one of the highest level seen in history. We also see, that shouldn't come as a surprise, price paid, the index is as 81, 100 would be the maximum. So the expectation that the inflation is going to rise and is going to stay is definitely here. The other positive news I definitely have to mention is the new orders were flat. That sounds very bad. However, they were flat above 66, and 66 is again one of the highest level on record. And with that, obviously, some narrative of the survey points also where the US is heading to. Managers keep struggling to find enough worker to keep up with the strong demand. So definitely the US is accelerating. This for me was a big surprise. Now you might say this is just the industrial part, the service sector is much bigger, fair point. But even the service sector keeps surprising. You see here as well, we are above 60, but as well, like in the industrial area, the prices paid indicator is above 77. So in both areas in the US, we have to expect that inflation will be sticky and is here to stay. I thought to give you the whole picture for once, we include Japan. Japan had a significant slowdown. The indicator, the orange line, is slightly improving, but still below the growth area. But the positive thing of indicators are the following. When you have a turning point, which we do see here, and when you have a slope which is upward sloping, a positive slope, that's a promising outlook for the next 12 to 18 months. Personally, I did not buy into the rally in the Nikkei because it was politically driven. Now we have seen a sell-off and we are almost back where we have started. But the good news here is as well, within Asia, Japan is very much connected, and most of the export and imports of China and Japan are connected to each other, and both areas do show sign of a recovery. We are still at the edge of the growth area, but at least we do see signs of recovery. The elephant in the room is on one hand inflation, but on the other hand, it's inflation which is not measured in the core data. And you probably have heard that there is a big energy crisis in Europe and as well one in China. Both areas have different energy mix and have different problems. In Europe, basically the key problem is that there is not enough natural gas. And the natural gas price has risen more than 40% over the last 2 days, but also more than 160% since April. Today I heard by coincidence that a study was produced. This could subtract 2% of growth of GDP growth in Europe. I make here my question mark because another news says that Gazprom is ready the latest at the end of this month to deliver whatever gas is needed to Europe. If that's including the Nord Stream 2 pipeline or not is open, but there is enough gas. China is a complete different story. China basically has forced the local governments to shut down the production of electricity done by coal. And that has definitely a significant impact on growth. The estimates are 4%-ish. I would argue that is extremely high, but the future will tell. So the big elephant, I said it before here in a different color, different angle, is CPI, actual and especially what is expected. And you can see from these forward curves of various European markets and similar picture in the US, inflation is rising, is here to stay. And if you follow what Mr. Powell, Mrs. Yellen, or Mrs. Lagarde has announced and testified over the last 10 days, the message a bit disguised, but the message was crystal clear. By the end of the year, the inflation figure produced will be higher than we are now. In the US, it might be 4% or higher. And in Germany, we are already at 4%. And Eurozone, the next data point comes out this week, but also in the Eurozone, it might be higher. This is not a surprise for those of you who follow this presentation regularly. I have said it last time and the previous times. I believe that inflation will be here to stay for much longer on a much higher level than we were used. This is on one hand deliberately done because this is the only way you can solve the debt to GDP problem in a real measurement or real terms. And it means that we have a hidden tax on our savings. Holding cash is not for free, as you know. And if you hold cash and you pay the fee to hold cash, on top of it, you even lose due to CPIs or due to inflation. And last but not least, CPI excludes, for instance, food and energy. And at least at the moment, the energy part is rising significantly. So the real inflation for your real daily life is probably much higher than the figures you can see. But let's assume for a second that these figures is the inflation. If you were to buy German government bonds, and I strongly suppose, unless you are working for an insurance or an institutional company, you will not do that. But with the latest figure, you end up with a real return at around -3.2%. I must add, I cannot update the chart until the next figure is produced, published, which is this week. So the real figure is probably lower, but the picture says it all. You lose as a starting point already nominal, and if you take the official inflation into account, and if you even take into account what I would call the real inflation you are experiencing, there's definitely a losing game to buy government bonds in Germany. Now you might say, well, we turn to the US. The rates have risen or the yield has risen. Sure, it has risen. The news, if you follow Bloomberg, is the dramatic rise of yields. Well, if I look just at the chart year to date, it is 20 bips, fair point. However, we were already higher in March this year. But the real story is here. Even in the US, the real return on 10-year treasuries based on core CPI, again, excluding energy, especially oil and gas, which are both soaring at the moment, you have a negative yield of roughly 2.7%. But that's not all. If you were to buy US high yield, and you take the yield of the US corporate high yield benchmark and you subtract the CPI data, wow, you end up with roughly 1.2% negative real yield. I mean, you buy junk bonds, you buy equity risk, and you get, in brackets, punished to hold them. It's definitely not a good business. Amazing enough, if you look at high yields on an option-adjusted basis, so spreads, treasuries versus high yield, global versus the relative benchmark, relative government bonds behind, you see there was almost no spread tightening. This comes really as a surprise because at least in the global index, you have as well China included. If I turn to China, obviously the picture looks much different. China at the moment is closed, Golden Dragon Week. It will reopen on Thursday or Friday. Already since May, you lost 12% on the index. And this is not the whole truth, because if you were to trade over the last 10 days Chinese corporate bonds, and you are using, for instance, Bloomberg, you see quote prices, they are not executable. On one hand, this week, because they have public holiday, but last week there was no public holiday. Even last week, when you saw a price of 90, you can be sure the selling price will not be 90, it would be rather 88 if you were lucky or lower. So this chart is a bit understating the real effect of the strong loss. If we turn to the spreads and compare double B bonds in the US and in Asia, which is mainly China, and I must say this chart is from Monday, so it might be even higher now, you see that the spreads are now at 590 bips over Treasury in China compared to roughly 250 bips in the US. The yield to worst is a very nice figure of 6.6%, and the duration of only 2.7. But here you really see that the spreads have widened. There is a lot of stress in the system. This week, yesterday, concrete, there was a second developer called Fantasia, a very small one, but nevertheless not able to serve international bonds. Evergrande is not trading anymore in the Hong Kong exchange. They are open, different to mainland China. It has to be seen how the whole process will be developed and how the government will interact. It is by Moody's and other credit analysts assumed that equity holders and bond holders will lose most or all of their money. However, project will be somehow finished with the support of competitors, with the support of government money. And so far in the interbank Chinese market, every day the Chinese government has asked the People's Bank of China to add significant liquidity so that the interbank market keeps working. They try everything to make this a single event and not a Lehman moment or an AIG moment, so that it is a local contempt event. The jury obviously is still out, but that's the take we have at the moment. If I read what Moody's keeps saying about the sector, on average, most real estate companies have more than enough cash for the next 24 to 36 months to serve all international debts. If you look, however, at the prices of the corporate bonds, international investors are not really believing that. And that's not really a surprise because people from the West have just sold everything, be it bonds and equities in China and in Asia. With that, let us turn to equity. As said in the introduction, September is the worst month of the year, and we have a pullback, not a correction so far. As you can see, the Nikkei, that's the blue line, including the overnight trading, we are now slightly down since the beginning of September. All the other markets, unfortunately, excluding today's fall, we are down 3 to 6%. This is still a pullback. This is still pretty normal. Not shown because the CSI 300 index stops at the end of September due to public holiday, but this index is down. No, actually, it's not down. In September, it is really flat. It's ±0. All shown in local terms. Obviously, we could currency adjust, but if we compare charts and moving averages, I prefer to use local currencies to see how much we have fallen from the top. Now, obviously, the more important and more interesting part is what can you expect from October? I came across this piece of research and the explanation of it. So on average, October is an okay month. So it is the seventh best if we look since 1950. So somewhere in the middle. And if you look at the last 10 or 20 years, it's among the top 4, which is already much better. This year is a post-election year, so it's the 5th place, still better than average. But, and now it comes the big but. This month is known as a very volatile month with a lot of days where you see 1% or bigger moves up and especially down. Therefore, what we see today after yesterday should not come with a surprise if you are longer in the market, or at least if you read the summary of the research, it shouldn't surprise you with hindsight. Having said that, obviously the question is, how will it continue? Short term, so I excuse for all purist and finance guy and CFA guys, but in behavioral finance, you learn that charts do have a value. If you're a finance guy, you learned what I learned. Charts are for the birds and voodoo. After more than 25 years in the industry, I changed my mind and I go now with the behavioral finance guy. And I would say charts can add value. And from a practical angle, I would say if you always look at the same ones and you produce them with the same technique, the same time frame, the same indicators. Here you see 200 days, 100-day, 50-day averages. Why these ones? Well, traditionally, if there is a pullback, a correction, you normally go back to these lines. And as you can see, the violet line was several times tested once the green line was tested over the last 12 months. It works pretty well because probably everybody looks at it. But now, as we speak today, the DAX and other European indices, be it the SMI, the Eurostoxx 50, they are below the yellow line. They are below the 200-day average. Therefore, in theory, we could fall much more. But we could also turn, as you can see, last year in October, November, there was a drop below the yellow line, but then it recovered. But as expected, when there is a pullback, Europe will have more pullbacks or even a mini correction compared to the US. That shouldn't be a surprise. And here I show you the S&P 500, exactly same chart, same technique, same time frame, and you see yesterday's rebound was not enough to overcome the green line. So we were closing below the 100-day average. And for those of you who follow me on Telegram, you know that I have written before the closing and this morning repeated, when we close below that level, the next move is down. So far, that's unfortunately unfolding, but in a very contained way. This chart looks much better given the outlook or for the economy. I cannot rule out that we will test the yellow line, but I would definitely bet that this pullback so far will continue to be minor. And even if we were to go down to the yellow line, to the 200-day average, then it's a minor correction of roughly 10-12%. If that's going to happen, I cannot know. What I would say is that normally the first 1 to 3 weeks of October are volatile and on average downward sloping. So it can well be that we go further down. The Nasdaq 100, the news flow was extremely negative. So for me, a small surprise when I pull up this picture. Again, same technique, same time frame. We are below the 100-day average. However, at the beginning of this conference, we were flattish, still below, but it can well be that we have reached a certain bottom. On Telegram, I have published a chart where you see the valuation of the Final Plus index versus the S&P. The premium of these tech companies has evaporated. So they are almost at the same level valuated forward-looking PE than the S&P as a whole index. So it is fair to say that the extreme overvaluation of tech stocks driven by the large caps is diminished, is almost gone. So how and why I believe this is going to come to an end? Fear and greed was yesterday in the extreme fear area. Today we are, of course, because of yesterday's rebound, slightly above. We are in brackets already in the fear area. But the key message here is very simple. When we are in the red, in the fear area, normally a crash doesn't start from that level unless you have an external shock, which we cannot rule out. So if China is going not just to interfere in Taiwan's air room, but maybe they might do something else, of course, then that would have a big impact. But let's assume that this is not going to happen, then at least from this indicator, you cannot derive that there will be a shock in market and there will be a crash. Investor sentiment. I mean, investor sentiment has dropped below 23%. When it's at that level and ISM is above 53, and as you probably remember, it's above 60, then the darker bars over 3 months, 6 months, 9 months, 12 months, the return of the S&P was always positive and outperformed the all period area. So also from that angle, I still believe that Q4 will be a positive quarter. This chart was supposed to use this blue circled area, so from peak to 50, which was true 1 month ago. However, as this is based on the ISM, we might be one step to the left and see this from 50 to peak bars. And there you see that the average return since 1980 is significantly positive and the second best on history. If you look at average, if you look at medium, it looks slightly better. But we are definitely not on the right-hand side from 50 to trough. We are not in any case reaching that area in the US. We are far away in Europe, and we are, as shown, rather going from trough to 50 in Japan. That's then on the left-hand side. And hopefully we are in China going from 50 to peak, or from trough to 50 we are already. So even China is the chance that we are going to see positive returns after the strong fall is here. Last but not least, everything depends on earnings. The consensus earning for Q3 and Q4 are significantly lower than the earnings we have seen in Q2 and Q1. Both Q2 and Q1 have significantly surprised to the upside. Analysts have started to price in a slowdown. So it has to be seen how in the end we will see Q3 and Q4 earnings. But with the slowdown included, you end up with consensus EPS of 200. Goldman is slightly more positive of 207. In both cases, the forward-looking PE is the trailing PE is roughly at 21. And if I include the estimates for next year, which are almost flat, which I definitely would say for the US makes no sense given the PMI data, we are then at a level around 20. This is obviously expensive, but compared to recent history, compared to alternative, in particular bonds, be it corporate, be it governments or cash, it is definitely worthwhile considering, or let's even say just investing into it. This chart came out today. It's exactly the same news, but shown globally. So you see the blue line is the forward-looking PE of the S&P. Here we are, 20. The guy who did that obviously says the US is the most overvalued compared to the rest of the world. I can only say yes, true, has been the case since March 2009. It was the best performing market, and especially it has still a very, very strong economy. The cheapest market is the FTSE. I was tempted to have that as a tactical trade. I'm glad I hesitated and didn't do that in the end, given the latest problems. As you probably know, the energy crisis there is on one hand gas, but on the other hand, they don't have enough lorry drivers, and therefore petrol stations basically run out of petrol and supermarkets run out of products, which is really special for one of the largest economy of the world. And all the other areas you see, Europe is cheap. I have changed my intonation. Last time I said Europe is going to outperform, and I thought until we see a pullback. Unfortunately, we are in a pullback and Europe has underperformed. And forward looking, I still believe that Europe will do well because there is a certain growth around, there's a certain fiscal stimulus around, but the US will do better, although we are higher valued. Last but not least, I believe there might be a catch-up rally in Asian economies. Some economies like Vietnam, they haven't corrected at all. Year to date, Vietnamese equity market is up more than 30%. Today, the market closed 0.3% in the green, while the rest of the world is red. With that, let us turn to commodities that we have more time for questions. We see here the Brent future. I could also have done the same for the WTI future, oil future. Basically, you have two effects. You have the leverage chains which are disrupted or interrupted. Then you have the hurricane season in the US. You have the Brexit. Boris, you have problems with gas. You have a lot of ships which are waiting in front of the coast in the US that they can go to the harbor to get rid of what they have loaded, in particular energy, but also goods. So this is going to last because there are backlogs, and once the system doesn't work clockwise anymore, it takes a long time until this is synchronized again. And last but not least, the OPEC for once has agreed to increase production, but only slightly, and the expectation were much higher. When I gave this speech 1 week ago, I had in the title a mean reversion for before the next pull up. You cannot even see the mean reversion. We had a drop of $2-3, but in the meantime, we are already on a higher level than we have seen last week. I fear that this will continue due to these effects I have mentioned and due to the effect that the heating season has not even started yet. Gold is a hopeless case. I mean, even today, as we see sell-off across the globe, gold doesn't rise. It has headwinds from stronger yields in the US. It has a stronger dollar. It is disloved. It has concurrence from other, let's call it, currency assets like cryptocurrencies. If you go a level deeper and you look at the mining stocks, they are cheap. Some pay even dividend, but there is no catalyst. So even when I talk to gold fans, they expect that the earliest in Q2 next year we might start to see a possible recovery and outperformance of it. How they come to that conclusion is open, because gold has no cash flow, so it's very hard to make a valuation of it. To make a discounted cash flow model is impossible. The dollar, if I'm not wrong, I said last time, maybe we are going to break out of the trading range. This is the DXY, so it's the dollar index, and most people use the red line, and you see we are above that trend channel. We are now even where the white line is at the edge of breaking above the levels we have seen over the last 12 months. And if that's going to happen, question mark, then we can see 2, maybe even 4 big figures. So I would not bet at the moment against the dollar. With that, let me come to the conclusion. We see globally signs of slowdown, but as I have also shown, there is also hope. Some PMI data surprise to the upside and stayed in the acceleration area. And where that's not the case, in particular in Asia, you see at least a possible turning points. Inflation is here to stay. Real yields are negative, therefore cash and government bonds, investment grade bonds, and to a certain degree also corporate bonds, but somewhere you probably have to invest, are not really delivering you a good return. I still believe that the central banks are deliberately letting the economy run hot, which in some cases has now a pause, but the consequence is the inflation. They need inflation to solve the debt burden. And that's called financial repression. I'm sorry to repeat that, but now you see it in the press. Some people call it that way. Some people just tell you are taxed with the negative yield. You can call it the way you want. What it basically means is if you hold cash, you lose money. That's the consequences. Why has the monetary stimulus not worked? We had that before. That's the balance sheet recession. Corporates did not lend, did not spend. This looks now that most companies are over, because there is now more people needed than people are willing to go back to work. So that angle is partially solved, and in particular we do see fiscal stimulus, which generates growth, but which will also generate to a certain degree inflation. The question was, shall you buy the dip? And the answer is, I think so. Over the next 2 to 3 weeks, you should use weekdays to add some equity exposure if you are not already invested at the level you would like to be. I'm so far astonished that the new investor generation, be it in Europe, be it in the Robin Hooders in the US, or be it the guys in China who buy on credit, have not sold out, although they have bought a lot with credits. When it comes to regions, I prefer now the US over Europe, and I still think that Asia will catch up. In terms of sectors, small caps, small values, and mid caps should do well, but that also on a global scale. There is a disruption in the chip area, which continues to be. If you are afraid of of inflation, the commodity space offers you some protection. I have here mentioned copper, uranium, also to a certain degree industrial metals. At the moment, gold doesn't work. as a tactical trade, probably energy prices are going to surge further, and some traditional energy stocks are still cheap priced. Maybe not the gas producer, but some traditional ones, and they pay you a decent dividend. Disregarding the ESG tendency, midterm, most of them, they might go out of business or have to reinvent what their business model will be. But probably oil is going further up, and I'm almost sure that we will see a spike before a mean reversion in the gas. The gas forward price is in a way that 30 to 50% lower the delivery for next year. You can fix that with futures. But if that's going to happen, we still would have a significant higher gas price compared to where we started. REITs, in particular residential REITs, which normally are in most countries, the rent is coupled to the inflation, is a place where you partially can protect yourself. I'm a bit repetitive, sorry for that, but there are no cheap assets. When I did the presentation last week and just updated it today, the theme I wanted to put is buy when there is blood on the streets. In German, the translation of that saying is buy when the cannons are still firing. This is from the Baron de Rothschild after the Waterloo battle, and he had an advantage that some messenger gave him the defeat of Napoleon. But the real whole sentence is buy even if the blood is your own. With that, I have concluded my speech. I would like to make you aware of our of our Telegram channel, where I comment daily movements and bigger pictures. It depends a bit what markets are doing at the moment, given that we have such volatile times. So there is a bit more communication. Sometimes there might be 2 or 3 messages a day max, but at the moment it makes sense to communicate a bit more what's going on. With that, thanks a lot for listening.
Andreas, thanks a lot for the presentation. Profound as always. I urge our audience to raise hands or type in questions that we can handle. I'll start with one on China's equity. Is it investable? Is China's investable? Is a big question, I think, out now. There are, as always, on big questions, there are polarized views. One is that it's just the communication of this restructuring and regulation tightening in China was done improperly, and companies will adapt and it will not impact earnings. The market will forget and forgive quite soon, and investors will, like international investors, will come back to China, and the market will go up. The other side of is saying that it's just we've seen just a small taste of what is coming in China with more central political power, and the risk-reward balance has shifted definitely to risk, with investors not knowing what's going to happen. So in what camp are you? And are you investing in China's equity, or have you exposure to this market?
Ooh. So I have attended several webinars, as obviously we cannot even travel to China or to Australia. But first of all, over the last 20 years, there were 3 crackdowns or regulation phase. This one is the one which is in the spotlight because since 2-3 years we can buy A shares and there's more coverage and the market has risen so far. So the first message is what's going on is not really new. New is the way it's done, and new is what is target. So can you invest? I mean, Alibaba, Tencent, etc. So all these ADRs, ADS are cheap. We don't know how much they have to donate, which is in the end the tax. So you don't really know what's the profit after tax forward looking. And if I'm not completely wrong, it was Alibaba who is kindly invited / forced to invest into the chip industry in order to build up chip industry, because the American government has decided that there's no access to chips anymore. Don't forget, the biggest chip producer in the world is Taiwan, which officially is independent from China. China obviously has there another opinion. But if you were to invest in that kind of stocks, I would recommend to buy them Hong Kong listed. If there is a delisting in the US, which is really quite likely, you are still safe and you are not interrupted. That is for a certain time being, you cannot trade the shares. However, the real interesting bit is the A share markets, not the H and not the international listed stocks. And there, as a private individual, it's extremely hard to get access to. However, there are fund managers which give you access to, and I have said it, I couldn't put it in the chart, the CSI 300, the Shanghai Shang Seng index was flat in September. This regarding all the negative news. Why? Because like in most other companies, the company or the economy is driven by smaller companies, by small mid caps. And they are not evergreens. They are not affected directly in most cases. The Western investor have sold basically everything they could. That's why bonds were hammered, and also why the equity market is in a bear market, is in a correction. But we see a bottoming phase. So if you have 12 months time, I strongly believe that the likelihood that you make money is 80%. Yes, you can buy it, but it's not a short-term story. Will there be more regulation? Maybe. There might be more clarification what they exactly want. But today I heard a speech. If you were Mr. G and you see that the Gini index is in a way that the concentration of billionaires is the highest of all countries in the world, and you are a socialist country, if I may call it that way, and you want as a goal to spread the wealth more evenly, it makes perfectly sense, all this regulation. If you want that kids out of poorer family can go to university, but at the moment it's only possible if you have these private expensive lessons after hours which prepare you for the exam to enter into the university, and you crack that down, and there are more angles to that. Or if you think that gaming is hindering you from being study or to play or to develop yourself, it makes all sense if you look it from that eye. I don't say it would ever happen in any of the country where the participants are listening, but this makes all sense. Having said that, I would strongly argue China is an extreme capitalist system, and they are not going to destroy their companies, but they will regulate them. They will put them in areas where they want them, and they will break up some monopoles. So, for instance, Alipay and WePay are now together on one platform, and it's not exclusive anymore. They're all steps to break up certain things, to make it more accessible, to make more competition, or to lower prices. The same holds true for the real estate market. But it will take time. So long story short, you have 12 months time. You have access to A shares, definitely. You want to buy the ADRs in America, most likely. So the Alibabas of this world will probably also be higher value down the road. I would recommend to buy them in Hong Kong. Sorry for the long answer.
Yeah, well, it's definitely difficult question. So as always, it requires some in-depth analysis. Thank you for that. There are quite a few questions from the audience about the commodity markets, about gold, uranium, copper. Alexander Lis has a question. Maybe if he wants to come on stage and voice his question, he can turn on his mic and talk about copper.
Thank you for taking my question. Can you hear me?
Yes.
Yep.
Yeah. So, about our elephant in the room, just wanted to ask if you see any other probable cases in other commodity market when structural underinvestments and supply shock can trigger events similar to as we have seen in the natural gas. Thank you.
If you phrase the question this way, the answer is uranium is definitely a candidate. Uranium has been in a 12-year bear market due to Fukushima, but also the European Minister of Finance have this week discussed the possibility of building new additional nuclear power station in Europe. The uranium future price and also spot market has risen roughly 30%, but is still at an extreme low level of around 40 to 43, I think, a pound. It comes down from an extreme high level of 130 12 years ago. And the uranium market is now driven by Sprott. Sprott is a trust who buys physical uranium. They have 1.5 billion assets under management since August, and they are not fully invested. So there is an additional demand. The seasonality speaks that uranium will go up over the winter. And then there's a newsletter who only covers since more than 10 years uranium. He believes that the spot price will easily go to 60. We are at roughly 40. And with it, the uranium mining can go up quite significantly. So that's a possibility of another area where you could see maybe not such a spike like in gas, but still a strong spike. And I forgot to mention there's the natural demand of the nuclear power station on top of it. And there are roughly 100 being completed in the next 3 to 4 years, and more are in plan, at least in China. Then copper is mentioned before, so that I cover it as well immediately. It has stabilized. It is not trading below its averages, but there is at the moment a trigger missing, but the green revolution is coming. At the moment, the main reason mentioned why it's not going up is basically that due to the slowdown in construction in China, copper might be less used. I don't buy that completely in. But I would still stick to the thesis Goldman put out that over the next 4 years, copper might go from roughly 9,000 to 15,000, but not in a spike.
Yeah,
okay, that was super helpful. Thanks.
Yeah, thank you. Another metal I would take a look at is aluminium. It is the reason is that production of aluminium is not ESG friendly due to energy consumption and the restriction. And again, coming to restrictions in China, where they try to regulate, on the one hand, pollution, on the other hand, energy consumption, is limiting aluminium supply growth. And the market turned from 1 million ton excessive supply last year to like a 1 million ton deficit this year. And this could be a structural problem going forward with limited supply in China and no capex elsewhere in the world. Just another one to look at. Among the commodity markets, we have also a question about gold. Anna has a question. Would you like to go on stage and elaborate? What's your you have a contrarian view, I guess, on gold. Anna?
Yes, actually, I just have some music the background. But yes, could you please, Andreas, comment about what you have said, that gold is pretty much hopeless. Could you please comment on this? Why do you think so?
I mean, the honest answer is, if I talk to the gold fans, and believe me, a lot of them keep calling and writing and trying to sell me their products. They are as hopeless or as without any ideas. I mean, what I've said is definitely true. A higher dollar is hindering higher higher treasury yields, expected rise in Fed fund rates and or tapering is all not really helpful. But when you have so much crisis and gold doesn't move, and you get whipsawed a lot of times. I mean, 2 weeks ago, we were at 1740, 1730, and I know a lot of people who are long with options, and they basically were wiped out. I don't know the answer. Nobody I know knows the answer. I still think gold plays a role in the portfolio, but only mid to longer term as a preservation of wealth and not for speculation. And I'm sorry, but more I really cannot say, because I haven't met anybody who were able to tell me a story where we are and why we are where we are.
Yeah.
Okay, thank you so much.
Yeah, thank you. Yeah, definitely the theme of commodities and other alternative investments like private equity or hedge funds is getting traction now with like less certainty of the direction of the equity markets. We don't have any other questions from the audience, and yeah, I think we can conclude at this moment. Thanks a lot, Andreas, for your presentation and very profound answers to the questions from the audience. Thank you.
Thanks a lot.
So yeah, we hope that in some time we'll be able to gather once again and listen to your presentation. Yeah, there is a comment from our listener who has already signed to your Telegram channel. So that seems to be a valuable source of information as well. Thank you. And yeah, that concludes our meeting today. Thanks. Thank you all.
Yeah. So Andreas, thank you very much again for your informative presentation, as always. And Maxim, thank you for moderating today's event. And thank you all for participating today. Don't forget to check our calendar in case not to miss any other events. And let's keep in touch. See you later. Thank you. Thank you.